Welcome to the Nichols Tax Update podcast. This program is produced to provide current information about developments in United States tax law. And the disclaimer goes on. I acknowledge the value in preparation of this program of my subscription to Tax Notes Today, published by tax analysts, which is, in my opinion, the preeminent source of information for tax professionals, and I rely on the information I get every day in Tax Notes Today to hint at what we should include in this program. What's here? 7 items this week. The standard mileage rates for 2022. We wouldn't want to miss those. And then the Ninth Circuit Court of Appeals affirms a need for consistent treatment of tax matters among circuit courts in one of the last remaining son of boss cases. I thought I would follow up last week's notation on the organizations that lost their exempt status. 15 organizations this week, including a school, lost their exempt status. And then I was amused by the headline, a miniature donkey breeding activity was a legitimate for-profit activity. I had to know more, and I thought I would share it with you since I invested the time to learn. Then no information returns are required for some discharged student loans that were part of the PPP loan program. Now, you could be forgiven for having a question about that because the PPP loan program was the Paycheck Protection Program. Were the students getting paychecks? No, they weren't. I'll explain where those loans came from. And then more John Doe summonses are coming in the IRS fight for information about cryptocurrency exchanges, and we'll talk about why one prominent attorney thinks that's not the right way to go. Finally, this week, an insurance company seeks to rescind malpractice policies based on material misrepresentation about the firm's participation in tax shelter promotion activities. We should all take note of this item and remember that the insurance company is not locked in if there are misrepresentations in the underwriting application. Well, here are the standard mileage rates. We get these every year. Business use, 58.5 cents for 2022. Charitable use, 14 cents. Medical and moving expenses, 18 cents. Now, let's go back to the business use. That 58.5 cents a mile includes a deemed 26 cents per mile depreciation. So that if you claim the standard mileage rate for business use of an automobile, you must also keep track of the depreciation, 26 cents per mile. So that when you dispose of that automobile, you may be surprised by having taxable income from the recapture of depreciation that you might not have remembered you were claiming in connection with the 58.5 cents a mile business use standard deduction. Don't lose sight of that. It's an important little record to keep in your client year-to-year file. Here's a very interesting item in which the Ninth Circuit Court of Appeals joined hands with the 11th Circuit to deliver exactly the same result to 2 co-conspirators that were promoting son-of-boss tax shelter transactions. Goddard lived in California, he's in the Ninth Circuit. Greenberg is in Florida, he's in the 11th Circuit. What these decisions do is uphold the tax court's calculation of tax deficiencies and penalty assessments against both men in separate appellate court decisions. The tax court's conclusions and calculations were the same for both men. Principles were the same. So here's a quote from the Ninth Circuit. This court has repeatedly emphasized that uniformity among circuits is especially important in tax cases to ensure equal and certain administration of the tax system. Continuing that quote, because we find the 11th Circuit's opinion in Greenberg well-reasoned and highly persuasive, we see no reason to depart from its conclusions. Now, what does that mean to us? It means to us, practicing in South Carolina, then we're not in the Ninth Circuit. We're not in the 11th Circuit either, I don't think. So how do we evaluate these decisions? We need to take careful note of the decisions of these circuit courts of appeal, because they are going to apply in our circuit, except in very unusual circumstances. There is an energy among the circuit courts, especially with regard to tax matters, to try to be where they can to be consistent, so they don't create conflict among the circuits and confusion in how the tax law is applied. I thought it was very wise and very carefully and wisely written. 15 organizations lost their tax-exempt status in 1 week. Final notices come in letter rulings. The question is why? In every case, one or all three of these things were present. The organization failed to establish that it operated exclusively for exempt purposes, not just part of the time, not just most of the time, but exclusively, and/or income was derived from non-exempt activities. Most of the income was from something that wasn't an exempt activity. You can't organize a tax-exempt organization and then engage in a trade or business for most of your income. And/or it operates to serve the private interest of its members or a private party. That's all it takes. Any one of those will cause you to lose your exempt status. Now, folks, the instructions for the Form 1023 that you would use to apply for a 501c3 tax-exempt status, you could apply for other exempt status, but the forms are different, are very clear. They provide detailed guidance. Not only the guidance, they give you the wording for your bylaws. And if you do what that document says to do and you don't depart from it, you will get tax-exempt, you'll get 501c3 status, and you'll keep it. If you don't, you won't. Breeding miniature donkeys for profit? I couldn't resist the headline. William R. Huff, TC Memo 2021-140. Mr. Huff's adjusted gross income exceeded $20 million with an M per year. He was an investment advisor, a money manager, $20 million a year, very wealthy man, had a daughter that wasn't doing so well. She had a dog grooming business. He wanted her to make more money, so he thought he could establish a profitable miniature donkey breeding business, and then he could give that to her so that she would have an income more fitting her station in life as the daughter of a wealthy man with a lot of income. The court concluded here that the taxpayer's conduct did in fact show attempts to make a profit. He had a trusted advisor. He paid an advisor to go to donkey sales and help him find miniature donkeys. And by the way, the pictures over here on the right, those are the three kind that they were most interested in. The miniature Mediterranean, the American spotted, and the red donkey. Those three miniatures. They're looking for donkeys that are under 30 inches high at the shoulder. It takes time to establish a breeding program. Mr. Huff and his advisor had been breeding donkeys when they came to the attention of the Internal Revenue Service for 8 years. IRS is only looking at 2 of those years. Well, Judge Erda applied the 9-factor analysis that we see applied time and time again to determine whether Mr. Huff's donkey breeding activity was intended to be profitable and was consistent with a majority of those 9 factors. For your convenience, I have listed the 9 factors in the next slide. Now, these are objective factors, not subjective, objective, which means that you've got to toe the mark. The manner in which the taxpayer carries on the activity, was it businesslike? Did the taxpayer become an expert? Were his advisors experts? How much time and effort did the taxpayer really spend in this activity? Did the taxpayer expect that the assets acquired and developed in this activity would appreciate in value? Had the taxpayer been successful in carrying on other similar activities? Well, the only other activity he'd put together was this dog grooming business for his daughter, which was profitable. What was the taxpayer's history of income or loss with respect to the activity? It was making money. Were there occasional profits, if any, from this activity? Oh, taxpayer's history of income or losses with respect to this activity, mostly losses. The amount of occasional profits? Well, he sold a couple of donkeys and recaptured depreciation, which kind of manufactured some profits, but that was it. The financial status, the income of the taxpayer? You're kidding me? 20 million? I don't think we worry about a $100,000 loss against a $20 million AGI. On the other hand, this guy, Huff, is going to really benefit from that $100,000 loss. Were there elements of personal pleasure or recreation? The record showed that Mr. Huff, in fact, did not like donkeys. He didn't try to ride the miniature donkeys. He wasn't amused by them. He didn't take his grandchildren out to ride the miniature donkeys. There was no element of personal pleasure. But I got to the end of the list, and I found this paragraph in the regulations. Neither a single factor nor a majority of the factors is controlling. Not even a majority of the factors. But rather an evaluation of all the facts and circumstances is necessary. Well, I thought about that a minute. I thought about the 9 factors. And I'm an Irishman, but I'm not totally stupid. That simply means the judge is going to decide based on all the information he gets. And in this case, he based part of his judgment on Huff's testimony. He was a credible witness. The judge decided, applied the 9 factors, thought about it, listened to Huff's testimony, and decided that Huff was entitled to this deduction. And then he warned Huff, you shouldn't expect that you'll be able to get this treatment from another judge in another courtroom for another year. Miniature donkeys? That red slash, that circle with a red slash over there means that an information return is not required for some loan forgiveness. Okay, what loan forgiveness? Student loan servicers should not file information returns or furnish payee statements under Section 6050P to report the amount of qualifying forgiveness regarding covered loans made under the Paycheck Protection Program. Wait a minute. Student loans? Paycheck Protection Program? Where did that connection get made? Well, some loans, grants, were made to students by colleges who got grants to help students stay in school. Now, that was part of the original PPP loan program that was not much discussed because it really was not going to be made available to every student. It was made available to students that were determined to be in particular state of need, worthy, qualifying, needy students, and these loans were administered by the colleges without any clear standards. You can imagine the abuse that could have taken place, and maybe did. But those grants, loans, whatever they were, no one is ever going to have to pay income tax on the amount of money the college gave to a student to help that student stay in school. A John Doe summons is going to be used by the IRS to continue to seek cryptocurrency information. I want to talk about what that means, okay? This article appeared in Tax Notes Today, which I've already told you is a very reliable source of information about what's going on in the federal tax world. This is an article by Mary Catherine Brown, who was attending conferences where the IRS executives are speaking. So she quotes Steve Dyson of the IRS Office of Fraud Enforcement, and he says, I think we're going to see an increase in John Doe summonses activity. What do you mean you think? You're the guy that sends them, right? Carolyn Schenck, IRS National Fraud Counsel. Expect more from the area of John Doe summonses. It's the tool we will be using. Now, those are the IRS lawyers. Enter Michael J. Desmond, former IRS Chief Counsel. Back in the late 80s, 90s, he was hotshot on writing regulations and writing the tax laws at that time. He's now a partner in a D.C. law firm. Go figure. He says it's a wonky way to ensure compliance. Using 1099s is a much more regimented and routine way of enforcement. Of course it is, Michael, because when the IRS uses a John Doe summons, it has all the information in response to the summons. If the cryptocurrency exchange sends out 1099s, your client will get a notice of audit, but the IRS will not have any of this information until you get a chance to jump in to the deal and get between the IRS and the client. Of course you don't like a John Doe summons. Of course you want the IRS to use a 1099. They're not going to be fooled, Mr. Desmond. They're going to use an effective enforcement tool to bring people to justice who seek to hide their financial transactions from not just the IRS, but from the world. Finally, this week, an insurance company is seeking to cancel a professional liability policy. That's a frightening concept, a frightening thought. Westport Insurance versus Cowan and Cordon, LLC, an Atlanta, Georgia law firm. The individual lawyers omitted some information, and the firm misrepresented the answers to some underwriting questions when they were applying for professional liability insurance. Some of the lawyers had individual policies, and the firm had a firm policy. Those lawyers and the firm got into serious trouble with the IRS due to misrepresentations they made in syndicated conservation easement transactions. Specifically, their participation in those transactions and their opinions were the subject of claims by their clients who lost their investment and tax benefits when the easement contribution deductions were disallowed due to inflated appraisals. The lesson is clear. Your professional liability insurance will only be valid if you tell the truth and make full disclosure in your application for professional liability coverage. Well, gang, that's it for another week. If you have questions, please, it's Lynn Nichols CPA at lynnnicholscpa@outlook.com. The phone number, 724-321-3387, is in the Eastern Time Zone, and I'm always glad to help with your tax questions. Meanwhile, please stay safe.